protests in favor of Black Lives Matter, which won a lot of praise from kind of, right-wing types, who are sort of into that kind of thing. And at the same time, the company was sort of making some pretty significant changes to its business to allow more of these kind of lightly traded, they're sometimes called altcoins, if you want a clean word for it.
For that.
These are basically, it's like the crypto equivalent of a penny stock. So some of them, of course, are legitimate. Some of them have sort of gone nowhere. But what has happened over the last year or so is that Coinbase went from being, kind of seen as a relatively sober-minded, one of the more conservative of the crypto exchanges, insofar as that's possible, to kind of embracing a more edgy, confrontational pose with regulators. Part of that is this kind of like cultural component. Part of it is listing lots and lots more of these altcoins, probably most famously Doge, which is like a joke cryptocurrency that the company added in May of 2021.
So I do wonder, I think about this in so many different ways. I think about going back to the tech bubble and, and then there were analysts out there pumping things basically that, they didn't really believe in those financials behind closed doors. But I also think about, the crypto world, it's like this freewheeling, it feels like to some extent, like, let's figure this out. And then there's what's the responsibility of these companies to investors, in terms of what they are, buyer beware, who's responsible at this point?
Yeah, absolutely. And Coinbase has done some of that. The thing that happened to this company is that, as I said, it followed initially. Coinbase has a long history. It's been around, I think, for almost 10 years, backed by some of the biggest names in tech. What happened is that it sort of fell behind the ball on these kind of lesser known currencies. So you had this sort of meme stock moment happen, and competitors, most notably Binance, basically distinguished themselves by allowing a lot more different securities, or sorry, I guess we're not allowed to call them securities because that's kind of Coinbase's whole position, but these different digital assets. And Coinbase kind of, in this frenzy to catch up, I think, basically allowed a lot more of these things on, and that's kind of where they find themselves today, where you have this Department of Justice arrest of a former Coinbase employee who's accused of basically insider trading, and then you have the SEC saying that some of these tokens that were being traded are in fact unlicensed securities. The upshot of that is that the SEC is maybe suggesting or interested in the question of whether or not Coinbase is operating a unlicensed security exchange, which would be really bad for the business, which is why we've seen the stock price collapse today.
And I guess the question is it a security? I mean, is it insider trading, Max? Because I think back to when the Amazon announcement happened for Queens. There were a lot of reports about Amazon employees having bought up real estate in Queens ahead of that. And people were saying, well, it's not really, insider trading because, we don't look at real estate in that way. And I'm wondering if we're looking at, altcoins in that way.
Well, and that's certainly the position of Coinbase. They put out, after these complaints dropped, the DOJ one and the SEC one, and it's important to say that Coinbase has not itself been named in any of these complaints. They're not charged. They haven't been sued. And although, Bloomberg has reported on this, investigation, the SEC hasn't taken any formal action. Their position, the company's position, is that it doesn't list securities. These things are digital assets, and therefore, it's in full compliance. There has been a lot of ambiguity over the last few years where it hasn't been clear what exactly the SEC is going to do, what is a security, what isn't a security. And again, we've seen Coinbase and some of these other players adopt maybe what you might think of as more aggressive poses as far as that question.
I guess I almost wonder too, Max, if we find out that there's some internal conversations, basically to the extent of, yeah, we don't really think this is anything, but we got to put it on our platform because if we don't, somebody else is. You do wonder, what's the responsibility of a company and its leaders when maybe they don't believe in something, but at the same time they know investors are interested in it.
Right, and this is kind of been something I think has been kind of whispered about in crypto circles, but maybe not said publicly until these, until this happened last week, which is that, there are a lot of assets on Coinbase that are, pretty obscure, right? It's not like Bitcoin and Ethereum. It's things like Protocol, which is a, social network for pets, right? It's very lightly traded, and you can buy and sell on Coinbase. And there's a question about when you invest in that token, what exactly are you doing? And I think the kind of Coinbase position, right, is that you're buying you're not buying a security, you're buying some kind of token that's going to be useful in this company. But I think the reality is a lot of people who are transacting in these digital assets are basically gambling, right? And then so there's a question about whether or not that should be regulated. And then there's also a question of whether or not, there's even a problem with that. Maybe, people are going to take these risks and maybe it's not a problem and maybe there's going to be a lot of innovation along the way. So certainly lots for the SEC and regulators to kind of work through.
Max, when you were doing the reporting for this column, what was the favorite altcoin that you found? I don't want to say favorite, but, what was perhaps the most surprising?
I mean, to me, Doge is still, and I know it's a cliched answer, is still the one that I keep coming back to because it was literally founded as a joke. I mean, it was not ever meant to be an asset. It was not ever meant to have any, any specific utility.
Right.
And it just kind of took on a life of its own, thanks to Elon Musk and these meme stock traders. And then you get in a situation where this kind of otherwise pretty sober-minded company feels like it's got to offer a meme coin to its investors.
Another Elon. Apparently you haven't heard of the Steno, which is really cool in certain circles.
So valuable.
All right, Max Chafkin over at Bloomberg Businessweek, a columnist. This is Bloomberg.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We are about 60 minutes until the end of the trading session. Caroline Hyde, Katie Greifeld, Gina Martin-Adams in for Taylor Riggs, joined now by our colleagues Carol Masser and Tim Stenovic. And we welcome, as we do day in, day out, our audiences across TV, radio and YouTube. And a market not looking too happy ahead of the Fed, Carol.
Yeah, absolutely. And that's what I'm thinking about ahead of the Fed. What does it mean for the bank stocks, which we see rolling over a little bit, down more than 2% in today's trade? I'm looking at the KBW Bank Index, and I do wonder what we get from the Fed. Higher rates typically mean banks, really profiting more from that net interest income. But if we hear some negative talk from Jay Powell and company, does that mean like a recession, slowing growth? What does that mean in terms of maybe loan generation going forward, Tim?
Is today about the banks or is it about retail? Because I can't get Walmart's report or Walmart's revision out of my head today. It's causing shares of the look at this, the Spider S&P 500 retail ETF to move lower, down more than 4% right now. More than 90% of the names in here are lower today, and it's not just Walmart. We got Rent-A-Center, Children's Place, Big Lots, and more on the decline.
And I think you were so right to point out Shopify as well, and the cuts there to their workforce, and the fact that things perhaps weren't speeding up in quite the post-COVID manner that they thought. It's really fascinating, some of the woes being cited by retail. Meanwhile, there are woes on markets' mind. S&P 500 off by 1.25%. We're down 50 points. Dow Jones off by 0.7%. We're hitting further lows on the day. We're off by almost 2% on the NASDAQ. Big tech front and center when it comes to earnings later today. And Russell 2000, it had been your outperformer for the last few days. It's now down 0.6%. Gina.
Yeah, a couple of bright spots when we look at the broader sector allocation within the S&P 500. Some stocks are up. Certainly healthcare, utilities, and real estate don't give you that warm and fuzzy feeling that it's a big risk on day. But nonetheless, some of the defensives are getting a little bit of a bid as Tim noted, the consumer discretionary sector really taking it on the chin due to the Walmart announcement, but also communication services, where Google or Alphabet happens to reside, selling off as well, and the tech stocks certainly not doing well either, as investors certainly nervous in advance of the close here.
Gina, it's a fair point that some stocks are up, but I want to talk about four that are, very firmly in the red right now. Tim mentioned Walmart. It's the story of the day. I mean, we were all on air yesterday when they shocked markets with that guidance cut weeks ahead of the earnings report, all coming down to the inventory pile-ups, a sign that inflation may be hitting demand. Walmart down 8%. The ripple effect, which is interesting, is what it means for Amazon, down over 5% today, of course, with people worried about what this means for Amazon's merchandise margins. And we have a ton of earnings today. Maybe one that flew under the radar was UPS, because inflation, a problem there too. They had delivery volume dropping more than expected, higher costs, fewer packages ordered. This story follows pretty logically. UPS down about 4%, and we have to talk about Coinbase. This after a Bloomberg News exclusive that Coinbase faces an SEC investigation as to whether it offered unregistered securities to trade. Real wipeout there, down about 20% right now.
And I think I want to go back to your talk about Walmart, about Amazon, about the consumer, because this also, I think, knocked nerves today. The fact that this conference board set of data showing just how far confidence is being pulled away by the consumer at the moment. Consumer confidence, as measured by the conference board, fell another 2.7 points in July, was lower than consensus, weaker perceptions in particular about current economic conditions. That's what's behind the decline. And in fact, guys, assessments for the outlook are the lowest since March 2013. What struck me, and to the Shopify point, is the job market details were soft in particular. Fewer are seeing jobs as plentiful, more are seeing jobs as hard to get, Carol.
Yeah, that consumer confidence number is interesting because you know what? If you're Unilever, if you're McDonald's, you can hike prices and consumers are paying it. And that's what we're seeing play out. So it really depends who you are, it seems to be, in terms of having the ability to pass along higher prices. Alan Jope is the CEO of Unilever, and our team caught up with him earlier, and he talked about pricing, what he expects in terms of inflation in the coming months. Here's what he had to say.
We certainly see peak inflation coming sometime in the second half. We're not there yet. And so I think we'll expect that sometime probably towards the end of Q3, beginning of Q4, we'll start to see the full flow through of commodity prices into retail prices in the market.
That's Alan Jobe, of course, the CEO of Unilever. That company actually saw its sales go up, consumers swallowing those higher prices. But Tim, I do wonder, we are hearing from CEOs that are saying that some of their consumers, they are indeed dealing with those higher prices, but talking about prices coming down in the coming months. We'll see if that starts to show up in the economic data.
Well, startling to hear from him, though, that he doesn't think we're at peak inflation at this point, because we did hear from Brian Moynihan last week of Bank of America, essentially saying that inflation is peaking. The question is, how long is it peaking for?
Yeah, and honestly, when the inflation prints are peaking, that's a very different thing than what inflation feels like in the real economy. And if consumers are still feeling the inflation, even if we're going from 9 to 8 to 7% year over year, it's still inflation. It still feels pretty painful.
And I'm really interested to hear what Jerome Powell has to say about inflation tomorrow, because he made the point at the last meeting, I believe, that there is this gap that's growing between headline CPI and core CPI, and theoretically the Fed cares about the core numbers. But I mean, Jerome Powell is pretty clear that we can't be too nuanced here. That's not actually what people feel. They just feel a lot of inflation. They're not paying attention to the nitty-gritty. So I imagine he'll get some questions about that.
Meanwhile, I think the administration is getting very nitty-gritty and very nuanced, because they are preparing themselves for what the GDP read is going to be on Thursday. We already know Janet Yellen, of course, the Treasury Secretary, is going to be taking to about 1:30 p.m. in the afternoon, going to be hosting a press conference around all of this. How are they going to be trying to say, look, I know that we're seeing a slowdown, but please don't feel it. We're doing a lot about gasoline prices and the like.
I think it's going to be really interesting, frankly. What do they know about what's coming on Thursday? I think there's all this chatter. We were talking about it yesterday with Tim about the technical recession versus non-recession. Are we going to get 2 consecutive negative GDP prints? Is it a coincidence that Yellen's going to have a press conference about the economy on the day we get the GDP number?
Yeah.
You tell me. You tell me.
Huge coincidence. Yeah.
Managing the message, perhaps? I mean, this is interesting, right? When we have some very key data points coming after these, the Fed meeting this week and the Fed decision, and you do wonder, I agree with you, how much does Jay Powell maybe touch upon some of them carefully and maybe give us an indication of what's to come, or at least what they are aware of?
I talked about this yesterday with Carol, but I think what's so notable in the days leading up to this, month's Fed decision is how much we've essentially decided that it's going to be 75 basis points. And the concern, last month over the debate about, okay, is it going to be 50, 75, or in fact 100 points, seems pretty settled at this point.
I thought for sure you were going to bring up the NBER. For sure.
The Business Cycle Dating Committee of the National Bureau of Economic Research.
We were going to have a very...
Should we name them? Steve Matthews, our colleague, has gone onto the Twitter to give us all their names, their dates of birth, the people that are behind it. So take our wrath to them.
Gotta love Steve. And always his work is a must read. All right, folks, we're going to be back in less than an hour's time. Our cross-platform coverage on radio, TV, YouTube, we call it Beyond the Bell. We're going to, of course, break down those earnings results from Alphabet and Microsoft. Lots to come. Chipotle as well after the close.
Meanwhile, we want to get you more analysis on what this market means, what we anticipate.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Tuesday, July 26th. Carol Masser along with Tim Stenovic. What a week.
Yeah, what a week. Hey,
What?
one thing I didn't get to mention just now, which I know we're going to be talking about in just a few minutes, is the idea of these, competing narratives that we're getting from companies right now. Got some good news from McDonald's, Coca-Cola, Unilever, but at the same time, some real, concerns from Walmart.
Yeah, exactly. I mean, the world's largest retailer, and they certainly, many would argue that they play into a certain part of the economic strata, right, in terms of the consumer.
Yeah, it wouldn't,
But how does that gel with, I would say McDonald's is the same thing.
Exactly. That's what I was having a conversation with a colleague this morning about this. I'm like, wait a second, is a lot of people eating at McDonald's, is that a good thing? Because people see it as a good value.
I don't know. I mean, gas has often been an important thing of Walmart as well. And it's interesting that they've come out, and they actually had warned earlier as well. So this wasn't like the first time that they were kind of managing downward expectations for the quarter. I don't know. I think there's a lot. This is our environment. There's so many mixed signals. We've seen prices come down. We've seen commodities come down. I don't know.
2 words.
What?
Labor market. Still hot.
Market. Yeah, it is still hot. And gets to the question, the debate, with our TV colleagues yesterday, like, how do you have a recession when there's still a hot and heated labor market and tight labor market?
That's the question. I mean, I'm sure we'll hear about that from Jay Powell tomorrow.
Yeah, exactly. I mean, a tight labor market gives the Fed certainly lots of room to be aggressive and really work at bringing those inflation numbers down. So maybe it's a good thing, but it's certainly a quandary.
Well, let's go to check the latest world and national news. For that, we go to Wendy Gillette in the Bloomberg 1130 newsroom in New York. Hey, Wendy.
Hey, Russia says it's pulling out of the International Space Station after 2024. Bloomberg's Amy Morris reports from Washington.
Russia says it will focus on building its own orbiting outpost after fulfilling its obligations to its partners before leaving the ISS. The space station is jointly run by Russia, the U.S., Europe, Japan, and Canada. NASA and other international partners hope to keep it running until 2030. The Russians have been reluctant to make any commitments past 2024. It isn't clear what will have to be done to the Russian side of the complex to continue safely operating the space station without Russia. In Washington, I'm Amy Morris, Bloomberg Radio.
In Ukraine, Russian airstrikes hit private buildings and port infrastructure today in Black Sea port regions. Ukrainian parliament member Valentin Nalyvaichenko spoke earlier on Bloomberg Markets.
What we see is that Russia himself, Kremlin, Putin, they try to, as much as they could, use their forces' efforts, even waging a gas war against Europe to attack not only Ukraine, but the whole civilized world.
Ukrainian lawmaker Valentin Nalyvaichenko. European Union nations agreed to cut gas use by 15% this winter. Sources say the Kremlin plans to keep the energy squeeze on Europe while the Ukraine standoff continues. Pope Francis has arrived for his first big mass in Canada. Tens of thousands are expected to attend in Edmonton to mark the Feast of St. Anne. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette. This is Bloomberg.
All right, Wendy, thank you so much. Carol Masser, along with Tim Stanovic, live in our Bloomberg Interactive Broker studio. So we've been talking a lot about kind of the quandary, or at least maybe we were doing it off air?
Yeah.
On air.
No, we were doing that on air.
But it's not.
We were doing it. We were talking about that.
In the consumer space, whether it's retail or whether it's, a Coca-Cola, McDonald's, a Unilever, a Walmart, you're not necessarily getting the same thing from every company. Well, I would say retail, who are dealing with maybe bloated inventories, because that was certainly part of the Walmart stories. I think that's what maybe makes it tougher versus maybe a Coca-Cola or a McDonald's.
But it's also highly stratified, like our society, Carol. And we see that worldwide, too. And nothing kind of makes me think about that more than what we saw from LVMH earlier today. Sales jumping in the second quarter as the owner of Louis Vuitton bags and Dom Perignon champagne continued to thrive despite lockdowns in China and soaring inflation. So let's go through some numbers here. Organic revenue in the company's key fashion and leather goods units, the French company, remember, soared 19%, compared with an estimate of 17% rise. That's according to analysts surveyed by Bloomberg. In addition to Louis Vuitton, brands such as Fendi, Dior, and Celine helped drive the uplift, the company said in a statement today.
Yeah, it's similar to what we've heard from Richemont and Burberry Group. They posted results that showed the appetite for luxe goods remaining even as price increases, the global economic outlook deteriorates, and China continues to pursue its COVID-0 policy. So this is somewhat of what we're seeing when you talk about strata, right? Like high end seems to be doing well, and maybe price moves don't impact a higher consumer or a wealthier consumer, if you will, versus somebody at the lower end who's got to maybe make choice between how much food do I put on the table, how much gas do I put in the car.
That's what I was just going to say.
Right?
Yeah, inflation.
Rent.
Inflation hits those hardest who are at the lower end of the economic spectrum, the income spectrum, because, okay, well, if gas is, X percentage of your income, if you're not making that much money and it rises more, then you have a lot less money for other essentials.
And I really wanted to know, as an elder millennial, are you an elder millennial?
I'm an elder millennial, yeah.
I wanted to see if you're
geriatric millennial.
Having less fun than anyone, but maybe we'll get to this story later on.
Because we're so busy with our kids, that's why.
Wah, wah, wah. All right, you're listening and watching Bloomberg Business Week on this Tuesday. Lots more to come. We're going to talk about some of the big stories. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are holding close to session lows. Walmart's certainly weighing on markets. The Dow, the S&P, NASDAQ all lower. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks under pressure from the start amid that drop in Walmart. Dow's currently down 224 points. S&P's dropped 48, while NASDAQ is lower by 1.9%. The U.S. 10-year yield at 2.79%. Gold is down 2. Oil is in the red. And Bitcoin is lower by 6%. Among the main 11 S&P sectors, only healthcare, utilities, and real estate were in the green. And leaders to the upside in the Dow on their earnings, 3M, Coca-Cola, and McDonald's. Walmart did fall 8% after lowering its outlook and led to the downside. Also after earnings, GE rose 5%. And in other news, Adidas cut its fiscal year outlook. Wrapping things up, Chipotle, Google, and Microsoft all report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much. We're going to be busy, and to hear live breaking news over your Bloomberg, type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week, watching us on YouTube. Carol Massar along with Tim Stenovic. And you know, the Fed's interest rate hikes, they are kind of wearing out their welcome in the bond markets. We've seen a measure of the yield curve that Chair Jay Powell has highlighted as a recession indicator, sending out a warning message. We're talking about the difference between rates of where 3-month bills are now and where they will be in 18 months. That's tumbled about 95 basis points in July. Biggest monthly decline in data starting in 1996. We keep watching these relationships and what's happening in terms of inversion
saying,
and so on.
Flashing warning signals about a recession, right?
Yeah, and we've seen some inversion, right? So we know the Fed's got a bit of a conundrum. Yank down inflation with aggressive rate hikes without creating a recession. That's not easy.
Well, let's get into it with Dr. Stephen Skanke, Chief Economic Advisor at Keel Point, also former U.S. Treasury and White House National Security Council staff member. We love it when Steve joins us ahead of Fed meetings to give us an idea of what to look for. Dr. Skanke, how are you?
I'm doing well. Thanks, Tim. Thanks for having me on. It's always great to be with you and Carol.
Yeah, well, it's always great when you join us, and it also means that we got the Fed chair coming tomorrow when you join us. So before we get to what to watch for, I want to go to Carol's point about recession concerns, because that's something that we're certainly going to listen to from Jay Powell. But what are you watching right now in terms of how you're thinking about the health of the economy?
Well, the health of the economy is actually pretty good. Obviously, growth is declining, but when you look at just some of the fundamentals, first quarter, second quarter industrial production up for almost 5%, a little better than 6%, respectively. Unemployment is below where we started the year. We've averaged more than 400,000 new jobs each month since the beginning of the year. Those are all strong indicators. To be honest, if this is a recession, it's the sort of condition that we wouldn't mind having from time to time.
I was just going to say, I'll take this kind of recession going forward. I mean, but you know what's
exactly
right? Well, but Steve, you know what's crazy? Like Tim and I scratch our head, and we do this with our TV colleagues when we talk about the markets and kind of the contrasting views about what's going on. It just feels conflicting, whether it's Walmart talking down their numbers, or McDonald's able to pass higher prices along, or Unilever being able to pass higher prices along, and consumer sentiment and confidence numbers coming down. I'm not quite sure how to read. Is it just the reset of our world post-pandemic, although the pandemic isn't over? Is that what's going on, and that's why it's so weird?
I think that's a good part of it, Carol. I think you just sort of put your finger right on the nose of it. Consumers are, all of the confidence and sentiment surveys show that they're just glum. And yet their balance sheets are stronger than ever. They continue to spend. Their outlook for inflation 6 and 12 months out continues to come down. All positive indicators. But when you look at what we've had, over the last 12 and a half years, but even just over the last 3 years, 2019, 2020, 2021, markets were up 30%, 18%, 30%. And so if you've been looking at your 401k over the last 3 years, being down 23.5% by mid-July is a real jolt. It just feels awful. Many people have even compared it to being worse than the financial crisis that we had in 2008, 2009, when unemployment was double digit,
right?
And just all sorts.
That doesn't make sense, Steve.
Though?
That doesn't make sense.
This is surprising
right?
to me. I mean, think about where we were just over 2 years ago. I mean, we had an S&P 500, Carol, that in 2021 was up close to 30% for the year.
And we knew that was mega outperformance.
Yes, it was. But we got it again in 20. We got it in 2021. We got it in 2019.
Right.
And even in 2020, which was weird because of the shutdown from the pandemic, the S&P was still up 18% for the year.
So we're going to watch a couple of, it's an interesting week where we obviously have the Fed meeting, Steve, this week, and that's obviously our focus tomorrow. But then after that Fed meeting, we're going to get a reading on second quarter GDP the first, right? And we're concerned about, what that might tell us about recession, not recession. We're going to get the PCE core, which are also key. Someone also talked about employment cost index. That's going to be really key, whether we're continuing to see wage pressure. I guess, what should we really be focusing on to give us a true indication of kind of where this economy is headed?
The numbers coming out on Thursday would be really instructive because we'll see what the components of GDP growth are for the second quarter, and a big interest is where we ended up with net exports. That's just the big swing here. The Atlanta Fed GDP now is still showing down 1.6% for the second quarter annualized rate. But when you go through and you calculate sort of from the bottom up with what consumers are doing, business investment, which is negative, government, which is neutral, and then you come to net exports, and the best estimate is that net exports are up between 1 and 1.2%, and if that turns out to be the case, then you're going to have positive second quarter growth. But if there's something that really is different about that, and in fact we do end up with a negative number, it'll be really important to figure out why.
Is that because that's an indicator? Why is that such an important one?
Well, because COVID, the shutdown in supply chains, the belief that supply chains are improving will all be reflected in what the actual numbers are.
Okay.
A lot of this is information that lagged, it's not real time. So if we end up a negative GDP growth number, the important thing is to figure out, what happened? Where is the problem, the economy that's giving us that number? What was it? Something crazy in inventories that's happened as a result of better supply chain deliveries from China? So it'll, to be honest, it'll really be in the weeds to figure out what's going to happen, because whatever the top line number, that's what the markets and the policymakers and the general flow will go with. I think it's really important to keep in mind that if the Fed raises by 0.25%, which I think everyone believes that they will, that puts us now at the neutral rate of interest, which, as Jay Powell said in his press conference after the last meeting, want to move to the neutral rate of interest, at which the Fed's policy is neither accommodative or restrictive. Because from that point forward, any increase in interest rates puts us in restrictive territory. And so what is the narrative that the Fed is going to about what they're going to do next? Is it to, we've arrived at a neutral rate of interest, now we're going to wait and see? Or is it, we really need to do more of this to move into restrictive territory?
We're talking to Dr. Stephen Skanke, Chief Economic Advisor at Keel Point, also former U.S. Treasury and White House National Security Council staff member. Dr. Skanke, if you could ask the Fed chair one question tomorrow, what would it be?
It would be, how much do you think they need to raise interest rates to squeeze out inflation this year? And then that would be the question. I'd also want to know, when are they going to start tariffs, which the markets generally
when are they going to what?
Believe is going to happen beginning in 2023.
When did you say when are they going to stop?
When are they? How much are they going to raise this? And then when are they going to start rates, which there is a general belief that will happen sometime in 2023, just because of the overshoot on the restrictive side, that may happen to squeeze out inflation.
Yeah, all I'm going to say is the tone, I feel like the negative tone, the drumbeat to me feels a lot stronger than it has in a while. So I feel like it's not too early to think about the Fed stopping or when it starts to cut.
We're starting to hear that a lot. I mean, Vince Signorella talking about that for weeks.
Yeah, exactly. Steve, thank you so much. Dr. Stephen Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member on the phone from D.C. We apologize to our viewers and listeners. We know the line was a little sketchy, but we always love what he has to say. His perspective is really a rich one.
All right, we also love Charlie Pellet's perspective. He's standing by right now with an eye on the markets with just over a half hour to go. Hey, Charlie.
Indeed, and looking at red on the screen. Stocks lower, Federal Reserve, of course, part of what's going. A lot of moving parts today in this market. Economic numbers this morning, weaker outlook from Walmart. That's also weighing on sentiment, and those recession fears running rampant as the Fed gets ready to deliver another big rate hike. Complete coverage tomorrow morning as we get the, tomorrow afternoon as we get the decision. And of course, the news conference, the all-important news conference, we'll have that for you live right here on Bloomberg Radio. The Dow, the S&P, NASDAQ, all lower, close to session lows on the S&P, down 49 now, drop of 1.2%. The Dow down 234, a drop there of 0.7%. NASDAQ down 232, a drop right now of 2%. 10-year yield, 2.80%. The 2 years, we keep an eye on the inverted curve, 3.05% on the 2 year. Spot gold right now down $2 the ounce to $17.17, drop there of 0.1%. And West Texas Intermediate crude retreating back below $95 a barrel, down 1.8%, $94.97 on WTI. Tech earnings going to be front and center after the close of trading today when we hear from Microsoft and Alphabet, parent of Google. Sarah Malik is Chief Investment Officer at Nuveen.
Currency issues, macro issues, and potential estimate cuts, and just breaking down Alphabet and Microsoft. Both of these companies have outperformed the tech index year to date. We think Microsoft is more defensive. They have more of a resilient commercial business, a nice dividend yield of about 1% to protect them. Alphabet likely runs into the same ad-related issues we saw with Snap and with Twitter. They've been investing heavily in their cloud and their AI business. This could hurt their margins. So, within that world, we think Microsoft probably puts up a better numbers and outlook than Alphabet does.
And right now we do have Microsoft down 3.1%. Alphabet is lower by 2.5%. Recapping stocks lower, S&P slumping 48 points, down 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Charlie talked about Walmart, that surprise cut to its profit outlook. We've talked about Unilever, Coca-Cola, McDonald's, Whirlpool. I mean, we are just watching the consumer space.
Okay, but I'm a little confused here because we're getting some bad signals from Walmart at the same time. Unilever saying things are okay. McDonald's saying they got pricing power. Whirlpool saying that long-term demand fundamentals remain strong. To help us clear it up, we got John J. Edwards III, U.S. Consumer Retail Luxury Team Leader for Bloomberg News. He's with us in the Bloomberg Interactive Brokers studio. What gives here? Because we're getting really mixed messages.
Yeah, we really are. And I think, some of it is actually telling versions of the same story. I think, Walmart was warning that it's seeing the mix of consumer spending shift in a way that it hadn't really expected, or at least at a pace that it hadn't expected. So people are spending more on food and fuel and other essentials, and less on sort of big ticket items and sort of discretionary goods purchases. And so that's hurting their mix and leading them them to need to move even more aggressively to discount, get those inventories down that have gotten sort of bloated, and so what we're seeing is, so that extra spending on food, for example, so that's helping McDonald's because they said their value meals in particular are doing well as people trade down. Coca-Cola also doing pretty well, and again, you talk about pricing power. They were able to raise their prices across their mix of products about 12%, which is the same thing that PepsiCo said a couple of weeks ago. So we're seeing it. It's a mixed picture, but overall, I think there's some consumer strength. It's just a sort of consumer shift in emphasis.
Right, in terms of, that is fascinating to hear you put it that way, because sentiment is down, but consumers are still spending out there.
Yeah.
So I just think thematically for investors, like, how do they get their head around it?
Yeah, it's tough. I mean, you mentioned sentiment. It is down because I think people are certainly seeing inflation, and it's certainly affecting them. However, employment remains pretty robust. People are employed; they're just annoyed, that they have to spend so much.
John, we do have to leave it there because we do want to head to former President Donald Trump at America First. His first time he's back in D.C. since being president and being in the White House. Let's listen in.
Well, I want to thank everybody, and it's wonderful to see so many friends and very, very familiar faces. It's a great honor to be with you. I want to begin by thanking the America First Policy Institute. My, have you come a long way, for hosting me for today's remarks, and in particular to recognize America First Policy Institute President Brooke Rollins. Brooke, fantastic woman. Another fantastic woman is Linda McMahon, chairwoman, and my friend Larry Kudlow. When I want to learn about the markets, I call Larry. Thank you, Larry. Thank you very much. We're honored to be joined as well by House Republican leader and a friend of mine and a good man, Kevin McCarthy. Kevin, thank you. Thank you. And I see your friend Steve. You don't leave without Kevin, right? Two great people, and thank you very much. And also to the many members, I'd introduce you, but you have so many, it would be all day. Many members of House and Senate, former members of my cabinet and administration, and state, local leaders, and countless other distinguished guests. Thank you all for being here. A real pleasure to be with you. Just 2 years ago, with the help of many people in this room, we had a booming economic recovery like nobody's seen before, the strongest and most secure border in U.S. history, energy independence and even energy dominance, historically low gas prices, as you know, no inflation, a fully rebuilt military, and a country that was highly respected all over the world by other leaders, by other countries, highly respected. Very simply, we had made America great again. We made it great again, and we did it by putting workers first, by putting families first, and above all, by putting America first. But now our country has been brought to its knees, literally brought to its knees, and who would have thought this could happen? Inflation is the highest in 49 years, 9.1%, and a lot of people think it's much higher than that. Gas prices have reached the highest in the history of our country. We have become a beggar nation, groveling to other countries for energy. Millions of illegal aliens are stampeding across our wide-open borders, pouring into our country. It's an invasion. Democrat-run cities are setting all-time murder records. Our country is being dealt one historic humiliation after another on the world stage. And at home, our most basic rights and liberties are totally under siege. The American dream is being torn to shreds, and we will not have a country left if this economic, social, and attack on civilization itself is not quickly reversed. Newt Gingrich, friend of mine who's in our audience, told me this morning that our country has not been this weak in terms of prestige and relative economics and respect since the Civil War. And yet, there is time for us to bring America back from the brink. It's at the brink. Got to bring it back from the brink. We gather today on the verge of a historic midterm election. The American people are poised to reject the failed reign of Joe Biden, Nancy Pelosi, Chuck Schumer, and the radical left in a momentous landslide. This is an incredible opportunity. This November, the people are going to vote to stop the destruction of our country, and they're going to vote to rescue America's future. I'm here before you to begin to talk about what we must do to achieve that future when we win a triumphant victory in 2022 and when a Republican president takes back the White House in 2024, which I strongly believe will happen. There's a tremendous amount to be done, from reviving our economy to liberating our energy to restoring our standing in the world. But for this afternoon, I want to speak about some of the core elements of our agenda, and in particular, public safety, of which we have very little. There's no higher priority than cleaning up our streets, controlling our borders, stopping the drugs from pouring in, and quickly restoring law and order in America. Under the Democrat rule, in Democrat-run cities, Democrat-run states, and a Democrat-run federal government, the criminals have been given free rein more than ever before. There's never been a time like this. Our streets are riddled with needles and soaked with the blood of innocent victims. Many of our once great cities, from New York to Chicago to LA, where the middle class used to flock to live the American dream, are now war zones, literal war zones. Every day there are stabbings, rapes, murders, and violent assaults of every kind imaginable. Bloody turf wars rage without mercy. Parents are worried sick that their kids will get shot on the way to school or on the way back home. Sadists who prey on children are released on bail, but there is no bail and there is no bond. Unique, never happened before. Drugged out lunatics attacked innocent victims at random. Roving mobs of thieves walk into the stores and walk out with whatever merchandise they can carry. They're left alone. Nobody tells them.
All right, you've been listening to former President Donald Trump returning to Washington today for the first time since he left the White House. He is speaking at the AFPI Summit, America First Policy Institute, and we will continue to monitor it. Of course, there are expectations that he could possibly make an announcement for another run for the White House, but whether or not we get something like that today, a lot of speculation about it, but we will monitor and bring you any key headlines and certainly anything that is of significance for our audience.
The former president not making any news there, but it is notable that he is back in Washington, D.C. for the first time in what, Carol, a year and a half at this point?
Yeah, significant. All right, Jody Schneider is our political news director at Bloomberg TV and Radio. She joins us on the phone from our New York City bureau. So, Jody, we're listening, we're monitoring. I think the thing that everybody wants to monitor and listen to is to see if he actually officially says he's going to make a run for it. What are you hearing from your sources?
Yeah, well, thanks. He is, that would be the news, right? And everyone sort of expects that, maybe not in an overt way, but more in what we call a wink-wink, nod-nod way. Clearly, even by coming to Washington and having this kind of grand kind of rollout, at his summit, and these people, the music blaring, and the whole America First theme certainly seems to signify that he wants to do something. You don't just come make a speech like this. This is, more of an event, staged event. And it comes in the afternoon after the morning where Mike Pence did not as grand a gesture, but he did have sort of a comeback for him where he spoke. He was supposed to speak yesterday, but air delays because of storms delayed that. Pence did not announce, but he did in his own more subtle way do sort of indicating that he may go that way and indicating that he would be very different than his former boss as well.
He did say that he thinks that a Republican will win the White House in 2024. Jody, I'm curious about the timing of whether he would announce this before the midterm elections. And if he did announce it before the midterm elections, if that would be an advantage or disadvantage to Republicans. I want to talk timing here.
Yeah, I think that's a really interesting question. And I think various people think it could go either way. First of all, there is some expectation that he would want to announce. Some people think that he would do that and then try to make the Democrats look weaker, that they should decide whether Joe Biden's going to run or not, and Joe Biden should decide before the midterms, which probably won't happen. But in terms of helping or hurting, Donald Trump's endorsements have helped some candidates win primaries this primary season, this midterm season, but other ones not so much, depending on where they are running. And there's also thinking that these primary candidates endorsed by former President Trump may not win their general elections. They may be viewed as too, radical, too out of the center to garner votes from like independents and women voters who, you're going to need in some of these key races, particularly in tough races and particularly in the Senate.
How much of this, though, is about money for the Republican Party? And we do know that, right, if he actually declares for 2024 a run, he loses control of a war chest if he does that. But I also do think by coming out speaking and kind of revving up the masses, even if he doesn't announce, how he helps maybe raise the financial coffers.
Yeah, and that's a really good point, because if he does, the clock starts running and you are an actual candidate. So that's why I think he may not actually announce. It may be this wink, wink, nod, nod thing for a while. I think he also wants to sort of push anybody else out of it. There's been a number of people who said they might run if Donald Trump was not running, and I think he wants to make it clear that he is running, and they should step out of the way, or that he might want to run. And I think he wants to clear the field some and test the field. The other thing that people have said, especially with the January 6th hearings, is maybe this is as much a legal strategy as an electoral one, and maybe that this would protect him from whatever legal charges could be brought. Who knows? But that is certainly something that is being talked about a lot in Washington.
On that front, U.S. Attorney General Merrick Garland, in an interview with NBC, leaving open the possibility of prosecuting Donald Trump in connection with inciting the January 6th attack on the Capitol. So it's all about strategy potentially.
Yeah, not surprising given what we've heard from the January 6th committee, Carol.
Correct, exactly. All right, Jody, thank you as always. Jody Schneider, she's political news director of Bloomberg TV and Radio, with us on the phone from our New York City bureau.
Let's get another check on the markets because Charlie Pellet is standing by. And Charlie, we got 15 minutes to go.
Indeed, 15 minutes until we get the latest numbers out of both Alphabet and Microsoft. Shares of both companies are trading lower. We've got Alphabet down now by 2.6%, Microsoft down 2.9%. Lots of earnings after the bell. Texas Instruments, throw them into the mix as well. Chipotle Mexican Grill. This morning we heard from McDonald's. McDonald's shares after earnings up now by 2.9%. Bottom line here, lots of earnings. Stocks are slumping after paltry economic numbers and that weaker outlook from Walmart. Walmart weighing on the Dow. Walmart down now by 7.7%. Dow Industrials down 248 points, down by about 0.8%. The S&P bouncing along the bottom here, down 1.2%, lower by 48 points. Nasdaq down 229, a decline of 2%. We've got the 10-year yielding 2.79%, the 2 years yielding 3.05%. Spot gold down 0.1%, 17.17 the ounce. Bitcoin is down 5.8%, back below 21,000, 20,886 on Bitcoin, and crude is down 1.9%, 94.88 a barrel. So a down day for stocks, a first day of a two-day Fed meeting. We've got a lot of key earnings out after the bell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:46 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. President Joe Biden's administration has been discussing changes to U.S. tariffs on China for weeks. People familiar with the discussions say a decision will come soon and that the result will be tweaks to measures put in place by the Trump administration, not a comprehensive effort to roll back import restrictions. That would be disappointing. Biden should start by completely dismantling Trump's Chinese tariffs and then go further. Trade liberalization would reduce inflation, and by injecting fresh competition into U.S. markets, raise longer-term productivity and living standards. One of the most disappointing aspects of Biden's presidency is that he has not decisively broken from his predecessors' misguided protectionism. This error can't be fixed too soon. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion. This is WBBR New York, WDCH-FM Bowie, Baltimore, Washington, WJZ-FM HD2 Catonsville, WRCA Watertown, WBOS HD2 Brookline, Boston, WNBP Newburyport, KNEW Oakland, KOSF 103.7 FM HD2 San Francisco, and SiriusXM Satellite Radio Channel 119.
I'm driving in my car, I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 11 minutes left of today's trading session. We're bouncing around, but we are just off our lows of the session. Really taking it on the chin is the NASDAQ, which is down more than 2%. Charlie talking about that. And we are getting ready for some big tech results. And we're talking about the parent of Google, Alphabet, as well as Microsoft. Both of those names. Microsoft's down about 3% ahead of that. Google's down about 2.6%.
Carol, we also got Chipotle coming.
We got Chipotle, which is just a little bit lower.
Yeah.
But we'll see if food prices, margins, like how are they
That's a really
doing?
good point.
Right? And how are they doing in terms of demand?
Hey, let's get into it with Bill Page, Senior Portfolio Manager at Essex Investment Management. Bill, this afternoon joining us on the phone from Boston. Bill, how are you?
Good, Tim and Carol. Great to be with you.
Yeah, great to have you with us. Okay, so is today's, I mean, I think, we've been having this debate over the last 10 days or so. What's more important when it comes to this week? Is it companies and their earnings reports and the commentary we're getting from them? Or is it what we hear from Fed Chair Jay Powell tomorrow?
Well, we're here at Essex. We're focused on really pretty focused bottom-up portfolios. I would say for us, it's about the companies. So we're sort of about 10 to 15% through our earnings season for the companies in our portfolios. We're focused on clean energy, clean tech, and so we're not as far along as we are in a lot of the S&P 500 companies.
Well, I was looking at performance. I mean, so far year to date, you're down about 26%, but I like a longer term perspective. So if I take it back to 3 years, you guys have been returning on average annually more than 11%, putting it into the 81st percentile in comparison to your peers, according to Bloomberg data. So, we constantly, and Bill, you probably have heard this and been asked about it a million times, about investors who are maybe looking to think about ESG when ESG you can really measure it, or a clean environment, like really invest in companies that are perhaps doing good and actually there's performance as well. It doesn't seem like it's as much of a trade-off as it used to be when you really have transparency on some of these names.
Yeah, there's been a lot of, obviously, headlines around ESG. What is ESG? How do you define it? And, our focus is really on solutions, so companies that are providing solutions to the world's greatest challenges. Mm-hmm. And we're focused mostly on small and mid-cap companies. And when you think about clean energy, we define it more broadly across 9 themes. So from water all the way through to renewable energy, offshore wind, et cetera. So a lot of these companies are older line industrial companies that are really moving into new end markets, leveraging their core IP. So water companies that are working on metering, electric utility companies, so services that can help electric utilities manage all the disruption for electrons and what's happening with our grid and the need for resiliency, et cetera. So
right.
we're finding...
It's kind of nuts and bolts, right, of what's going on.
Well, it's really... So when you think about clean tech, it's really been around for 25 years in listed markets, and now we're in this new realm. I think valuations were a little ahead of themselves back in 2020, but we saw, as you are following, too many listings of companies that should not have gone public in sort of the last 18 months. But now it's, valuations have come down significantly, and the fundamental drivers for clean tech are stronger than ever.
Well, let's talk about some of those, because I think what interests me so much about what you work on is the idea that, a lot of these companies are really reliant on governments. And I wonder what you see as terms of progress here, not just in the U.S., but around the world, and opportunities for these companies if they're in a space that's somewhat slow moving. I mean, look at how long this energy transition is taking.
Well, it's interesting. I mean, when you think about the legacy of fossil fuel assets power global economies, fossil fuels have been driving, our economies for, almost a century. So when you think about the clean technologies that were discovered in some cases 30 years ago, we're not really in the early days of this transition. If you think about net new energy additions to the global grid, renewables added more than coal last year. 10% was the combined energy supply of renewables last year, so much higher, up 20% year over year. So, Tim, on the government incentive side, that's a bit of a misperception.
Well, I guess what I'm saying is, like, we're still seeing stories about, the grid melting down in Texas, 2 years after that tragedy.
Exactly. And so when we look at, first of all, we're global, and then we assess government incentives. One thing we look at is what's happening on tariff structures, feed-in tariffs, government support, in relation of other drivers. And the most important driver, one that eclipses all, is, does the technology work? Is it commercially viable? On the grid, yes, indeed. I mean, our electrical grid, we're still leveraging technology that's a century old, but I think it's really coming to the fore that if you look at what some of the large utilities have been doing the last several months, is they've been finally starting to invest in the grid, and that helps some of the companies in our portfolio that help with grid resiliency in managing electrons. When you put in bidirectional charging for electric cars, which is happening at a faster pace, solar panels on the roofs, and battery storage, you have more disruption, more electrons that need to be managed by utilities. And this is, for instance, one of our companies is Itron, providing a good value proposition as we digitize our grid, the amount of data that the utilities need to manage is much greater, and obviously they need to bring the electrons to their customers at a time when it's getting harder to do so with, as you said, Tim, severe weather and wildfires.
Right, and that's ticker, Itron is ITRI. It's based in Washington. Stock's down about 21% so far this year, but that is a name that plays into what you've just been talking about. I just want to draw everyone's attention to another name that you like. The ticker is ERII. It's called Energy Recovery, based in California. It's down about 5% so far this year, but the last 3 full years, stock is up 219%. Tell us about this, because this has desalinization, in terms of seawater and filtering it out to produce fresh water. We see that a lot in the Caribbean, but this is a company that also plays big time in the Middle East, and that has to do with energy, right?
Exactly. So when you think about energy recovery, it's not a well-known or followed name, and so it's all about harvesting fluid flow in a plant.
Right.
So they've got the bulk of the market share for what's known as SWRO, so seawater reverse osmosis energy recovery. So when you think about a large desal plant, the greatest input cost is energy. And so their technology can lower the operating costs for a desal plant by over 70%. And then when you think about what's happening in the Middle East, over 90% of their water supply is potable water, meaning it is all desal, and over 50% that is going to agriculture. So they can't operate the Middle East, their economies, without desal. And so ERI's got a lock on global energy recovery technology for desal plants, but then they're moving into industrial water treatment. And so industrial water treatment regulations are increasing in the emerging markets.
Right.
And there's also a need, as we deploy, obviously, more onshoring of semiconductor manufacturing here in the U.S., for us to have really cheaper methodologies and ways to treat our water. And so that's another way. It's equally lowering the input costs for commercial facilities. This is early on for them, this new end market. And the other one is refrigeration. So we're phasing out HFCs, refrigerants that are incredibly hurtful to the climate change. It's over 100 times more CO2 intensive than regular greenhouse gases. So refrigerants is another area they're moving to too.
Right, and that's certainly where the regulatory side of things can, kind of require companies around the globe necessary to do it. Hey, Bill, we do have to run, unfortunately, but this was fascinating, interesting. So come back soon. Bill Page, Senior Portfolio Manager at Essex Investment Management, on the phone from Boston, as we mentioned, his Pear Tree Essex Environmental Opportunities Fund has an average annual gain over the last 3 years of about 11%, so putting it in the 81st percentile. All right, folks, we're just a few minutes away from the closing bell and some big earnings from Alphabet and Microsoft, also Chipotle, so we will be breaking them down after the closing bell. In the meantime, equities bouncing around. We're just off our lows of the session, but still down about 1.9% on the NASDAQ and down about 1.2% on the S&P 500. Let's head over to our TV colleagues for Beyond the Bell, counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are 2 minutes away from the end of the trading day. Caroline Hyde, Katie Greifel, and Gina Martin-Adams in for Taylor Riggs, counting you down to the closing bell. Here to help take us beyond that bell with a global simulcast, Carol Massa, Tim Stenovic, bringing together TV, radio, YouTube audiences worldwide to really talk about not so much the moments in this day, but the moments in the days to come, the earnings, the Fed, and of course, we still reel from Walmart yesterday.
Yeah, I feel like we keep waiting for that party to begin. But Google and Microsoft are reporting after the close, and those stocks are definitely underperforming the broader market today. You've got Google and Microsoft both down about 2.6%, of course, Alphabet, but they are certainly trending lower here ahead of their important earnings report.
It's not just those companies, though. We also got Mondelez International. We got Texas Instruments, so we'll have a check of the health of the chip sector. And then Visa is coming today, too. And we're going to get an idea of, how the consumer is doing, hopefully, when it comes to Visa. Is it another American Express story like last week?
Yeah, and let's hope that we get a little bit better news than we got out of the retail sector last night from Walmart, because that's very clearly just absolutely creaming the consumer discretionary stocks in the S&P 500, with more than 90% of that sector down. I do think that Walmart really took any kind of wind out of the sails of the market. We need some sort of positive news to reinvigorate optimism here.
Absolutely. I mean, it was a very, very defensive tilt today. And you marry that sort of defensiveness that we saw in stocks with what we saw in bonds, a real sell-off today. It was a little bit of a mismatch there, but definitely defensive if you take a look just at the equity market.
Yeah, some of the correlations not making much sense today, with oil down because maybe the dollar was higher, but then other places it's more an inflationary story. Natural gas once again on the rise. Geopolitics comes in to muddy these waters once again. Meanwhile, though, we got 10 seconds and the bells do start to ring. The jubilation is sounded at the stock exchanges, even though, well, we did say money coming off the table today. The S&P 500 is closing at about 46 points lower. We're down by 1.2%. 3,920 is where we end the day's trade. The NASDAQ, though, is your underperformer. Big tech down by 220 points. That's 1.9% to the downside. Dow Jones Industrial Average relatively outperforming, but still off by 0.75%. And even the Russell 2000, having been buoyed of late by some healthcare stocks on the rise, it was off by 0.9% as well, Carol.
Yeah, and we're talking about big tech, we're talking about consumer-based companies, retail companies, but housing stocks, home builders, were down about 1.2% as sales of U.S. homes fell for the 5th time this year in June to a more than 2-year low. So watching that part of the sector as well.
Microsoft coming out with earnings, and 52 billion is a miss, though. 51.9 billion was where the estimates was, and indeed we're coming in at 52.45 billion overall. So fourth quarter revenue is a miss. Productivity revenue coming in basically in line with expectations, but earnings per share $2.23. Overall, intelligent cloud, that's important as to where the businesses are spending, Carol. 20.9 billion, lower than the expectation for the market.
Yeah, absolutely. And we're seeing it a little bit lower in the aftermarket, down about 0.5%, but we're starting to see it climb now up about 0.8%. But what's really key, and we have to see the dollar impact on this company, but cloud, always key when it comes to something like a Microsoft or a Google and certainly Amazon Web, because those are the 3 big players. So that intelligent cloud revenue, that came in a little light, 20.91 billion versus the estimate of 21.07 billion. That fourth quarter revenue revenue, though, that also light overall. Maybe that's why you're seeing some hesitancy in the trade back and forth here. That fourth quarter revenue, let's go back to it, $51.87 billion versus $52.45. Recorded operating expenses of $126 million on Russia. So we continue, Tim, to see also that impact on some of these big players.
Yeah, I'm looking in the commentary that we're getting from Microsoft right now. Amy Hood, the company's executive vice president and CFO, saying that, quote, as we begin a new fiscal year, we remain committed to balancing operational discipline with continued investments in key strategic areas to drive future growth. That word discipline really sticking out to me, showing the market and showing investors that, hey, they are still investing, but doing so in a way that takes into account the environment that we're seeing right now.
Interesting. You also see Microsoft shares now decidedly turning lower, down over 3%. This stock had been down 25% year to date coming into today's earnings. Looks like the knee-jerk reaction is decidedly negative. We also have earnings coming out from Texas Instruments. Their second quarter revenue beat, their second quarter EPS beat, and the third quarter revenue guide is higher as well than some of the estimates as well. You can see Texas Instruments moving higher in after-hours trading, Caroline.
Meanwhile, Alphabet, we were looking for a key player, of course, the Google parent company. They're seeing a cloud loss, as many had expected, but bigger than anticipated. $858 million operating loss for the cloud. The market wanted to see about $630 million loss. They're seeing operating income of $22.77 billion in their services department. That's a bit lighter than expected. Overall, cloud revenue was $6.28 billion. That's also light. Other revenue, $6.55 billion. That's also light. So down across the board, really. Overall, we are seeing the other bets operating loss looking pretty large. Remember, this is the area that they were trying to curtail some of their expenditures from. Ruth Porat, the CFO, trying to withdraw some of those riskier bets, but $1.7 billion is the loss. The estimated loss of $1.22 billion. Interestingly, operating margin basically coming in line, 28%, so margin's still under pressure. We're seeing earnings per share come in like $1.21. The estimate was for $1.32. And really, they are seeing just a miss across the board. Operating income, $19.45 billion. The estimate was for $20 billion. And when you look at the big round numbers, $69.69 billion for second quarter revenue. The estimate had been for $70 billion. And when you take out some of those traffic acquisition costs, $57.47 billion, so $57.5 billion, and the estimate had been for $58 billion. So this is a miss in whatever way you look at it. It's not huge misses, and therefore we do see the stocks powering up about 2%. We want to dig into really why. Let's get to Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence, madly trying to look through some of the details. Give us a sense of why perhaps we might see a bit of a reprieve or relief. Is it because the stock sold off so hard today?
Yeah, well, and the buy-side number was much lower, so I think a lot was already baked in. But look, there's no denying the fact that ad spending is softening, and it's impacting Google as well. I think investors are really focused on that cloud number because cloud continues to be unprofitable. When you think about Amazon and Microsoft, both of their cloud operations are profitable, north of 20% operating margin. So it begs the question, if Google is really diversifying, why can't they do it in a profitable way? And it doesn't show up in the numbers here. And I think that's where investors are concerned.
So what's the plan? What are they going to need to do to get that segment profitable?
Well, so, I mean, you could argue scale is what makes them profitable, but they're at a run rate of $25 billion, and there aren't many software companies at a $25 billion run rate that aren't profitable. So they're really plying through in terms of hiring more salespeople. But this is the type of environment where companies are announcing hiring freezes. So they will have to do something about the cost side. And at the end of the day, you have to figure out whether these are profitable contracts and they're just spending a lot on sales and marketing, or they're just unprofitable to begin with.
All right, so Mandeep, what is this company trading on? The stock's down. Google, we're talking about Alphabet, down about 27% so far this year, but we are seeing it pop in the after hours, now up more than 4%. What are investors trading on, and are they rightfully doing so?
Well, it was less than feared, and everyone was so fearful that, things would really fall off the cliff, and it may very well happen to Meta tomorrow. I think what Alphabet has shown is their ad spending is still holding up. You're talking about low teens growth. YouTube was a slight miss, but net, they aren't as impacted by privacy changes as some of the other social media names. I mean, Snapchat really took down guidance from growing high teens to growing flat. quarter over quarter. So I think that's the big difference between a Google and the other social media names.
So Mandeep, why is Google then better positioned in this world where, Apple announced these iOS changes that ostensibly are about privacy, but are hurting companies like Meta Platforms and Snap so much? Why is Google better positioned?
I mean, look, they own their Android operating system. So we talk about ad pricing going down because of Apple's privacy changes. Ad pricing changes on the Android side are in Alphabet's control. They don't depend on Apple for that. And so because they own that platform and YouTube is all brand advertising, it never depended on Apple's signal to begin with. So it doesn't get as impacted as a Meta, which is really relying on Apple's IDFA to give them the signal for ad targeting. So overall exposure is much lower compared to some of the social media names.
Mandeep, always so swift to respond, give us the insights. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence. And of course, we do have so many more earnings to really be getting through. We've got Mondelez, we were going to be waiting on Visa overall. I mean, Katie, I think you can drill into that particular sector.
Yeah, let's look at it. If you look at the third quarter EPS coming in at $1.60, you could say, that is higher than expected. That was expected at $1.18.
Well, that's the year-on-year comp.
That's the year-on-year comp. They did say that the cross-border volumes were at constant currency at about 40%. So parsing through some of the details there.
Yeah, it looks like a beat on an adjusted earnings per share basis, $1.98. The estimates were $1.75. And the net revenue coming in better than expected, $7.3 billion. So ones to be really digesting into. We await Mondelez and some of the other spending coming from the consumers. But overall, it looks like a Mr. Microsoft, a Mr. Alphabet, a beat for Visa, and we're going to be digesting so much more of all of this. That does it for our cost platform coverage from the markets close on Bloomberg TV, radio, and YouTube, though. Back tomorrow. Hey, Carol.
Yeah, we'll be back tomorrow. Still lots to come.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so a lot of earnings after the closing bell. I was looking at the NASDAQ mini futures contract because it's down about 1.6% because I care about that. I think about Google and Microsoft, the impact on some of these major indices. Google is up 3.5% in the after hours. Microsoft is down 1.5%. So I'm wondering how this tech space might trade going into Wednesday.
Yeah, let's not forget Visa. It's up in the after hours more than 2.2%. A really important read on the consumer. We got from the company's CEO against the backdrop of macroeconomic uncertainty, significant exchange rate headwinds, and the suspension of our business in Russia. Visa had a very strong quarter. Revenue's up 19%.
Yeah, it's about
company.
Yeah, and it's about 1% of the S&P 500. So you think about what composition it is within some of these indices, and so ultimately what it will impact in terms of the trade.
Well, let's get a check the latest world and national news. We go to Wendy. Hey, Wendy.
Hey, as you heard live about a half hour ago, former President Trump has returned to Washington for the first time since leaving office, delivering a speech hours after his former vice president spoke to young conservatives. Now, Mike Pence is a potential rival in the 2024 presidential race.
I truly do believe that elections are about the future, and that it's absolutely essential at a time when so many Americans are hurting, so many families are struggling, that we don't give way to the temptation to look back.
Former Vice President Pence also said he did not differ with the former president on issues, but they may differ on focus. The Senate Judiciary Committee asked leaders of national police organizations to testify on the increasing violence directed at officers. Bloomberg's Irv Chapman reports from Washington.
Demetric Penny, president of the National Fallen Officers Foundation, suggested defund the police would be harmless if it were only a bumper sticker, but not when it proliferates on social media.
Radical groups, individuals use this content to incite violence against police. When that image is attached to hashtag Black Lives Matter, hashtag defund the police, hashtag kill the police, we need to have better control over the content that's being used to incite violence against police.
The Chicago chief said police are now confronting criminals armed with heavier weapons and magazines that outgun the cops. In Washington, Irv Chapman, Bloomberg Radio.
Crews are making progress against the largest wildfires so far this year in California. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette. This is Bloomberg.
All right, Wendy, thank you so much. Carol Master, Tim Stanovic. I've got a million screens up on the Bloomberg because I have to, because I'm trying to track all of these earnings. Let's go to the parent of Google and, of course, Alphabet. This is a big player in the ad search space, certainly, and, of course, in the cloud space. Google shares, Alphabet shares, are up about 3.4% in the after hours.
Yeah, second quarter revenue, excluding traffic acquisition cost, ex-TAC, it's an important metric that the company uses and that investors use. That came in a little light, Carol, 57.47 billion. Estimates were for 58 billion. Total revenue for the company also coming in below estimates, but just below estimates at 69.7 billion. Estimates were for 70 billion.
Yeah, their cloud business falling a bit short of analyst expectations and continuing to bleed money. This is something that our Mandeep Singh pointed out, that in contrast to what we see from Microsoft and Amazon, these are the three big players, folks, when it comes to the cloud space, that Google seems to, Alphabet seems to struggle. and it's interesting because everything seems to be up in the cloud. So that is certainly one key point that we're watching. But nonetheless, Google shares continue to trade higher, up about 3% in the after hours. Do you want to mention Microsoft, though? It is down, Tim, about 1.3% after market.
Yeah, shares down even after a day, Carol, where they actually, earlier in the day, I should say, overall, total today, if you include where it closed, down close to 4% because it did get hit. I want to go to this comment that Amy Hood, the Executive Vice President and CFO, said. She said, as we begin a new fiscal year, we remain committed to balancing operational discipline with continued investments in key strategic areas to drive future growth. So the investment continues, but it's discipline now because we're in an environment.
And this is from Microsoft.
Yeah, this is Microsoft, the CFO of Microsoft.
Well, one of the headlines that we did point out on the Bloomberg when it comes to Microsoft, fourth quarter revenue was light, $51.87 billion versus an estimate of $52.45 billion. And their cloud revenue, their intelligent cloud, that was a little light, $20.91 billion versus an estimate of $21.7 billion. Commercial cloud, $25 billion versus an estimate of $24.99 billion. But again, this one is trading just a little bit lower. We're going to talk a little bit more about those Microsoft results in just a moment, right here on Bloomberg Business Week on Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Alphabet after earnings trading a little change right now. Right now down less than 0.1%. Also after earnings, we've got a 1% drop in Microsoft. Microsoft reported quarterly sales and profit that did fall short of analyst projections, held back by the stronger dollar and weaker corporate demand for cloud services and software as global growth totters. Alphabet's ad revenue held up better than expected. Shares again virtually unchanged after ours right now, also reporting moments ago Visa and Chipotle. Texas Instruments reported revenue for the second quarter that did beat the average analyst estimate. Today, a down day with the Dow, the S&P, and NASDAQ all slumping. Paltry economic numbers and weaker outlook from Walmart certainly weighed on sentiment today. Walmart, by the way, down 7.6%. S&P fell 45, down 1.1%. We had the Dow down 228, down 0.7. NASDAQ down 220, a drop of 1.8%. 10-year yield 2.80%. The 2-year yield 3.05%. Spot gold down 0.1%, 17.17 the ounce. West Texas Intermediate crude down 1.6%, 95.16 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie talking about all the earnings after the closing bell, including Microsoft. Stock still down about 1.5% in the after hours. The company reported quarterly sales profit also that fell shy of analyst expectations and projections, held back by the stronger dollar and weaker corporate demand for cloud services and software as global economic growth totters. I got to tell you, Anurag Ron, I was listening to him earlier. He said these were things that were going to be potentially that could impact the company.
Yeah, not surprised because he follows this company so closely. He's senior software and IT services analyst at Bloomberg Intelligence. Anurag joining us on the phone from Chicago. Anurag, you've had like 10 minutes to dig into these earnings. Give us the big takeaways here, apart from the top line and the bottom line. What sticks out to you?
And you called it right. I'm just going to put it out there.
Yeah, you did. You called it right. Kudos to Anurag.
It is the strong dollar, and it is going to have an impact going forward as well. In fact, it will be much more going into next quarter than it is today. As we thought PC is going to be weak, PCs were weak, cloud strength was good. So overall, I think the biggest thing for us to look forward, frankly, is when the CFO gets on the call and talks about next quarter and how should we think of the individual segments. Frankly speaking, in our view, there is no reason, you should not see a slowdown in Microsoft. It's such a big part of the overall, global economy. But we feel that 70% of its portfolio is resistant to a recession and will still grow even if we get into, a deep recession.
Yeah, so, I look at these numbers. I mean, they're still big numbers, right?
I mean, think about it this way. I mean, from my side, this is a company that generates over $200 billion in software revenue. The software market is somewhere in the $700-800 billion. So they are 1/4 of the entire market, growing double digits. I mean, I do not know what else to say. They're growing faster than the market, frankly.
Well, and I'd like to do that because I feel like sometimes we lose perspective and we're like, oh my God, but I mean, and the stock's only down 1% in the after hours. To me, I agree. So it's really kind of outlook and what we hear from the company going forward.
Yeah, and that's what I was. Go ahead, Anurag. I know you're going to say something.
No, go. I mean, the whole point is essentially that there are certain secular trends we have around the world.
Yeah.
And the biggest one of them is cloud. These guys are right in the center of it. Second is modernization of applications of companies who have been in existence for 20, 30 years. These guys are at the center of that too, because they have a massive footprint of applications that have been developed over the 20, 30-year framework. Then lastly, productivity applications, things that all of us use to do our job. It doesn't matter what the economic activities are. You're not going to get rid of Excel and PowerPoint and Word.
Right.
So from my point, it's just such a critical part of any economy.
Carol, who are we talking to at Milken who said, in a recession, you're not going to cut the tech spend?
Oh, was it Katie?
Is it Goldman Sachs?
Yeah, I think so.
Yeah, it might have been over at Goldman Sachs, and she made the really good point.
You're not going to cut. You're not going to cut when it comes to these tech applications.
Yeah, you're not going to not use Excel.
Right, like you have to in order to operate your businesses at this point. Anurag, what's different about the Bill Gates Microsoft versus the Steve Ballmer Microsoft versus the Satya Nadella Microsoft?
I think I can just sum it up in one word. I would say it's the era of openness. It's the era of embracing that is not yours. So, for example, Microsoft embraced open source more than anybody out there. That was not the norm, back in the 2014 timeframe. And I think that has really helped them because a large portion of the workloads on Azure, which is their cloud, is open source. Their ability to work closely with their competitors really makes a huge difference or compares them to other legacy software companies.
Yeah, this is a company that has seen many business cycles too, Carol, right? Where it reminds us that it's been around for so long. Anurag, I want to go to what Amy Hood, the company's chief financial officer, also executive vice president, said in a statement. I've repeated this a few times because it's sticking out to me. Quote, as we begin a new fiscal year, we remain committed to balancing operational discipline with continued investments in key strategic areas to drive future growth. So in an environment that is uncertain right now, essentially is what she's saying, we're going to keep investing, but we're going to do so in a, quote, disciplined way. How are you reading that statement?
So I think one of the things for everybody right now is, how do you expand margins if the growth rate slows down a little bit? This is a company that's been growing, let's say, top line between 15 and 20% in constant currency for the last several years. I think the growth rate slows down between 10 to 15%, no less than that. But even at that point, if they can grow revenue, let's say between 10 to 15% and expand margins, I think investors would be happy about that because in a bad environment, you can grow earnings 15% plus. That's pretty impressive.
So, Anurag, when we think about earlier this month when Microsoft cut less than 1% of its 180,000 person workforce, and these were groups like the consulting and customer solutions, but it still said it planned to finish the current fiscal year with increased headcount. I mean, we have talked a lot about some of these big tech names and what they're doing with their workforce. I mean, is this just Microsoft shifting and allocating resources where it makes sense? And just got about 30 seconds here.
Yeah, I would say more investments in R&D and other areas could see a cutback. But this is part and parcel of what happens in the tech world. We have massive shortage of tech talent right now. All of this is going to help, fix a little bit of that pressure.
All right. Well, listen, you always give us the right perspective when it comes to a company like Microsoft. Our Anurag Rana, he is Senior Software and IT Services Analyst at Bloomberg Intelligence, our in-house group of analysts, research analysts, joining us on the phone from Chicago. Microsoft now just down about 0.9%, so pairing somewhat of its earlier loss.
Yeah, like I said, a company that has seen many business cycles, right, Carol? It knows how to pivot, too. I mean, think about what it did from like the 10 years from 98 to 2008.
Right. I love what Anurag said. There's certain secular trends that are around the world, and Microsoft is in the middle of it, and that's why longer term, the story makes sense. You're listening to Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, everybody, we are watching shares of Google's parent company, Alphabet, in the after hours. Stock's up about 2.3%. We're going to get into it with Angelo Zeno over at CFRA Research to see what he has to say about the quarter.
Yeah, we covered Microsoft. Now we're going to cover Alphabet, the parent company of Google. First, though, Charlie Pellet, lots happening in the after hours. Where to start?
And we love it that way. That's what we do here at Bloomberg. We got you covered. Google parent Alphabet reported second quarter revenue that met analyst expectations, reflecting the internet giant's resilience amid slowing growth in advertising. Mandeep Singh is a senior tech analyst at Bloomberg Intelligence.
There's no denying the fact that ad spending is softening, and it's impacting Google as well. I think investors are really focused on that cloud number because cloud continues to be unprofitable. When you think about Amazon and Microsoft, both of their cloud operations are profitable, north of 20% operating margin. So it begs the question, if Google is really diversifying, why can't they do it in a profitable way? And it doesn't show up in the numbers here. And I think that's where investors are concerned.
And he mentioned Microsoft. It's out with quarterly sales and profit that fell short of analyst projections, held back by the stronger dollar and weaker corporate demand for cloud services. Anurag Rana is a senior software analyst at Bloomberg Intelligence, and he was interviewed moments ago right here on Bloomberg Business Week.
So overall, I think the biggest thing for us to look forward, frankly, is when the CFO gets on the call and talks about next quarter and how should we think of the individual segments. Frankly speaking, in our view, there is no reason, you should not see a slowdown. In Microsoft, it's such a big part of the overall, global economy.
And we'll have more on Microsoft for you coming up in just a moment. Shares lower now. MSFT down by just about 1.1%. Texas Instruments reported revenue for the second quarter that did beat the average analyst estimate. Stocks lower today. Walmart among the stocks declining, one of the prominent stocks, down by 7.6%. The Dow down 228, down 0.7. S&P down 45, down 1.1%. NASDAQ down 1.9%. 10-year yield 2.79%. Spot gold today down $2.31 the ounce, down 0.1%. 17.47. West Texas Intermediate crude down 1.5%. 95.24 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
And just want to mention that Chipotle Mexican Grill, it is rallying the after hours after reporting second quarter earnings that topped analyst projections. The burrito chain adding new locations. Consumers proved they are willing to pay more. The company also provided an upbeat sales outlook. That stock, Tim, is up about 8.5% in the after hours.
All right, we'll tune in tomorrow because at about this time, we're going to be chatting with Brian Niccol, the CEO of Chipotle. So we'll get the skinny on what's going on there.
All right, also up in the after hours, we're talking about shares of Alphabet, the parent of Google. They're up about 2.2% here. So let's get to it with Angelo Zeno. He's senior equity analyst at CFRA Research. He's on the phone from Long Island. He's got a buy rating on the stock. Recently cut the 12-month price target to 130 from 2,600 to account for that 21 or 20-for-1 stock split, and also adjusted estimates lower at this time too. Let's see what he has to say.
Angelo, good to have you with us. So results coming in at or near estimates, shares are rising, advertising revenue holding up better than Snap's. That's what I wanted to get to. So after that brutal quarter and report from Snap last week, are you pleasantly surprised by what we're seeing with Alphabet?
Yeah, I mean, listen, I don't think I've been this ecstatic for a miss in a long time.
Because it wasn't as bad as it could have been? What is it?
Yeah, I think there was a lot of fear out there in terms of what the numbers could have looked like, especially on the ad side of things. And I think overall, search grew percent. It's 58% of their business, right? So overall, the numbers look pretty good. I think, one thing we're telling clients is Alphabet's search business, their ad-based platforms, much better than Snap, Twitter's, even Meta's. And a big reason for that is just the return on investment that you kind of get if you're a customer across kind of Alphabet's search business. Not to only mention, when you start thinking about some of the issues these other companies had to contend with, iOS changes and what have you, it's become a lot more difficult for advertisers to really kind of measure the performance of and target kind of these customers But Alphabet had an issue, and I think you're kind of witnessing the benefit of that here on these results.
Yeah, our live blog on the results saying the sales gains indicate the company's ad business, especially its search ads, may be positioned to weather a crunch in marketing spending, which we know has affected some of the smaller players out there, including Snap and Twitter. We've seen that. They did our blog also pointing out, Angelo, that the company is nevertheless remaining cautious, saying that it temporarily paused hiring. To me, that speaks responsibility among a company, right? If they're not sure, then let's just kind of hold back.
Like it's mature.
Yeah, exactly. So, so where do we go from here? Like we're just, on pins and needles. What a week with these big tech results. We've got a Fed meeting. How do you feel like it's starting to kind of shape up here?
Yeah, I think overall this is just going to be a mixed landscape. We remain very constructive on these large cap tech names, but clearly you have to be more selective in nature. In the term of Alphabet side of things, I mean, listen, they've got so many levers they can also pull on the cost side of things that they're better able to navigate kind of some of these issues better than others out there. But I mean, there's a clear distinction between companies like Alphabet and Apple, which are great compounders, great free cash flow generators, whether you're going in an upturn or a downturn, relative to others out there, like Shopify, which just today cut 10% of their workforce, and they were just aggressively looking to expand at any cost, and that's really biting them in the butt right now. So I think you've got to be very conscious and very kind of selective when looking at some of these tech names, but clearly focus on these kind of great secular stories on the large cap side of things.
I don't know, Angelo. I just want to get to a point where they're not asking me to join YouTube Premium every time I go to try to watch a YouTube video. That's just so annoying.
Want it.
I know. If I did, I would have done it already. Hey, let's talk cloud here. When is the company going to start being profitable on the cloud? I mean, after all, Amazon is profitable there.
Yeah, I mean, listen, there's a big difference between Alphabet and Amazon. I mean, when you start thinking, Amazon, Microsoft are significantly bigger in terms of the cloud. They dominate in terms of the market share. They've got over half the cloud share out there. Alphabet's a company, you're looking at a growth rate of 36%, right on target in terms of where our assumptions were. Still a fairly small part of their business, about 9 to 10% of sales.
But is that a mistake? Is that a mistake that they're not being more aggressive with it? If you think about
Yeah. So listen, I think this is one of those things where they're not going to be profitable because they're not at that scalability yet. So we do think over the next 8 to 12 quarters that they will be. But the problem is, if they were to get more aggressive, clearly that's going to cost a lot more. So I think they're kind of being prudent here in many respects. They're trying to take advantage of the opportunities out there without kind of really disrupting the profitability out there of the company.
All right, Angelo Zeno, so great. Senior equity analyst at CFRA Research, joining us on the phone from Long Island. And we are watching shares of Google still up about 2.9% in the after hours. Results coming in at or near estimates. Ad revenue holding up better than Snap's, and the CEO saying that search and cloud drove the results.
Could have been worse, Angelo Zeno says.
Yeah, right?
Ecstatic about a miss.
It's like, whew.
Yeah, big sigh of relief.
Breathe, everybody.
Let's get to check a world of national news. We go to Wendy Gillette in the Bloomberg 1130 newsroom in New York. Hey, Wendy.
Hey there. A new survey finds many parents are reluctant to vaccinate their youngest children against COVID. Details from Bloomberg's Amy Morris in Washington.
The Kaiser Family Foundation found 43% of parents of children under 5 say they definitely won't vaccinate their kids. 53% say they think the vaccine is riskier than COVID. 70% say they have not yet talked about it with their pediatrician. 10% said they'd get their kids vaccinated right away, and 7% say they already have. 27% say they want to wait and see. This is Kaiser's first survey since vaccines for young children became available more than a month ago. In Washington, I'm Amy Morris, Bloomberg Radio.
The Senate needed 60 votes to advance a bill to subsidize American production of computer chips. 64 senators voted in the affirmative, so the bill is a step closer to a presidential signature. Bloomberg's Irv Chapman reports from Washington.
Democratic leader Chuck Schumer urged passage.
It will make historic investments to scientific research. It will take direct aim at our nation's chip crisis. It is one of the most consequential bipartisan achievements of this Congress.
Senator John Cornyn expressed support but did not speak for all Republicans.
Chips underpin virtually all the technology that keeps us safe at home and protects our troops around the world. Microprocessors underpin literally everything that has an off and on switch.
President Biden has been appearing with technology industry leaders to press for the bill. In Washington, Irv Chapman, Bloomberg Radio.
The actor who played Wally Cleaver on TV's Leave It to Beaver has died. Tony Dow was 77. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Wendy Gillette.
You ready for a burrito bowl?
Oh, you read my mind, chicken.
Well, you're always hungry.
That is true. Guilty as
Especially at this
charged.
time. There are no burrito bowls, but it does seem like consumers...
How'd you know my order, too, by the way? That's kind of scary.
Just a good guess. Chipotle out with their results after the closing bell. We're going to catch up with the CEO, Brian Niccol, tomorrow. But this stock, it is soaring in the after hours. Folks, it is up about 8.4%.
Yeah, the second quarter earnings topping analyst projections. The burrito chain added new locations. Consumers are willing to open up their, wallets and pay more, Carol. An upbeat sales outlook. Let's go through some of the numbers here. Profit $9.30 a share in the quarter that ended June 30th, excluding some items. That surpassed the estimate of $9.09 compiled by Bloomberg News. Chipotle sees the key gauge of same-store sales growing in the mid to high single digits in the third quarter. I want to hear more about margins.
Yeah, I want to know about costs. The food is fresh. They don't have freezers, so, they've got to make sure they're getting their supply. They have access to their supply chains. They have what they need in inventory to make sure they meet demand. They did add new locations, and I think this is very key, Tim. Consumers prove they are willing to pay more. That is not the case everywhere, but we are seeing, right? We saw it in McDonald's. We saw it in Chipotle. Remember, McDonald's used to own a big chunk of Chipotle.
There's just McDonald's DNA in it.
Right? So it's interesting, some of these themes that are coming out, but it's not across the board. Profit, $9.30 a share in the quarter ending June 30th, excluding some items, surpassing the estimate of $9.09 compiled by Bloomberg News.
They got pricing power, too. Chipotle benefited from higher menu prices in the quarter. It did have fewer deliveries. It meant that the related fees were lower, too. There were higher hourly wages and food costs. That's weighing on profits, but still, restaurant margin came in above estimates, 25.2%, Carol, versus an estimate of 25%.
Expanding locations, especially those with pickup windows, they still expect to open between 235 and 250 new restaurants this year, as long as construction, permit, and material delays do not worsen. But those kind of digital processes where they just have the pickup windows has really been a big boom for them.
Brian Niccol, CEO, on with us tomorrow afternoon.
Right now, that stock up 8.4% in the aftermarket.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Texas Instruments, the maker of chips used in everything from washing machines to satellites, out with a bullish forecast for the current period, countering concern that a slowing economy is hurting demand for electronics. Microsoft and Google parent Alphabet now trading little changed after hours. Microsoft reported quarterly sales and profit that fell short of analyst projections, held back by the stronger dollar and weaker corporate demand for cloud services and software. Google parent Alphabet reported second quarter revenue that met analyst expectations, reflecting the internet giant's resilience amid slowing growth in advertising. Turned out to be a down day for the Dow, the S&P, and NASDAQ ahead of the Fed tomorrow. S&P down 45, a drop there of 1.1%. The Dow down 228, down 0.7. NASDAQ down 220, a decline of 1.9%. Walmart certainly weighing on sentiment today as well. Walmart was down 7.6%. 10-year yield 2.80%. Spot gold down 0.1%, 17.17 the ounce. And West Texas Intermediate crude dropped 1.3%, 95.46 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Bloomberg NEF recently reporting how the tipping point for battery electric vehicle ascendancy has been reached globally. And it's about once 5% of new car sales go fully electric, everything changes, according to a Bloomberg analysis of the 19 countries that have made the EV pivot, which kind of got us wondering about battery recycling overall.
Well, fortunately, we got Marcus Randolph with us. He's executive chairman, CEO, and president of EcoBat. It's the world's biggest recycler of batteries. Marcus, great to have you with us. I want to talk about the business in just a second, but give us a macro view of your world right now and help us understand the biggest challenges your company's facing.
Sure. So battery recycling, let me start with the quiz. I love this because it sort of helps people understand what batteries are about. What do you think is the most highly recycled product? So
I know what it is because I looked at the website.
Yeah, but you put your paper out on the curb, yeah. You know, and lead battery recycling 99% and 99% recovery of lead through the recycling process. So lead is by far the world's best recycling story.
And we're talking about batteries like, you know, Duracell batteries?
No, those aren't lead.
Lithium ion, just lithium ion?
I'm referring to lead acid batteries now.
So where would you find those?
Well, car batteries.
Car batteries,
you know,
right?
Those big black boxes
Boat
you got in your
batteries.
cars with the two little posts on them? Yeah, those things. So we recycle 130 million of those a year.
Wow.
Yeah, big number.
So what happens as we move to EVs? What does that mean for you?
Well, EVs does two things. One is it obviously it opens up the world for lithium-ion batteries, which are very different. However, I think, and we'll talk about that in a minute, I'm sure, but one of the things that gets missed is EVs also use lead-acid batteries. So all the safety systems in EVs, so, you know, the lithium part is the motive part, but your power steering, your power brakes, if your lithium battery disconnects, you don't want your car to lose control.
Right.
So all the airbags and stuff comes from lead-acid batteries. So a lot of people say lead-acid batteries are going to die, they're going to be replaced by lithium. Not true. You know, they're still going to be used. Admittedly, they don't use as much lead acid as a car does, but it's still a substantial part of our going forward business.
So how much demand, or what are you seeing like in your business in terms of dynamics, like growth of business and so on and so forth?
Sure.
And some of the main themes that we talk about, whether it's inflationary pressures, labor pressures, tell us a little bit about that.
Well, let's step back. I mean, you know, the thing you're never going to get away from is what does it mean to have this big boom in EVs, and what is that going to do for lithium? So, you know, the low end of projections is sort of 20% compound annual growth rate.
Right.
You know, when you're, you know, that didn't really matter much when, you know, you're just selling a few of these a year, which is where we were 8 or 10 years ago.
Everybody's worried about lithium and whether or not we have enough.
Now, I mean, you know, including plug-in electric hybrids, last year there were 6.6 million electric vehicles sold. 6.6 million.
Right.
Almost double what they were the prior year. So you say, where's this industry going? For us, lithium is both our greatest threat and our greatest opportunity. So you look at what we're trying to do as we go forward, and that's to be, we are by far the industry leader in the lead acid side, and we are rapidly becoming so on the lithium side.
Because you have to.
Well, because we want to. in other words, to be honest, I mean, it is going to be challenging for lead acid batteries over the long term because lithium but their energy density is much more favorable,
right?
And their ability to fully discharge is better. So they have big advantages, but on cost they get killed. And so if you have low-cost applications where you need big surges of power, that's right down the world of lead acid batteries. As you get over to cars that have long, steady draws that last for hours, lithium batteries are fantastic.
Right.
They're just expensive. They're hard to recycle. So I give you the numbers for lead acid, 99% recycling and 99% recovery. Lithium recoveries now, the EU is trying to legislate 65% recovery, and there are a lot of companies that aren't making it.
Meaning that 65% of the lithium in a lithium-ion battery is recycled?
The metals.
Is recovered?
Yeah, nickel, copper, cobalt, iron.
How usable is it on the other side of that recycling?
It is and it isn't. This is where...
Smart question.
Yeah, actually, that really was a smart question.
Thank you, guys.
As people talk about, growing the smart economy in the U.S., well, you look at lithium batteries, the lithium, nickel, and cobalt deposits in the U.S. are not very good. So all this stuff comes from someplace else. Then the manufacturers are very interested in retaining control through the recycling process. So lead acid battery, you get rid of it out of your car, you leave it at Pep Boys, and they give it to us, and it just disappears in the system. In lithium, the car manufacturers want to own that stuff right through the process. And you just keep going, and it's a pretty different business. But kind of the takeaways here is you're going to see a lot of demand. I think there are a lot of questions about, is there enough supply? The recycling is really important, particularly because the manufacturers want to own the resources. It's a different world.
But the question I think that you're asking is, when you recycle it, is it 99% comes back to the manufacturer, or is it 50%?
Great.
Where does it go?
You did well, actually. So what happens? So they don't have the deposits. So they ship the materials here, they make the batteries, or they make them in China. By the way, China has, you remember the gigafactories? Well, China has about 10 times more than the U.S. does. So you start severely disadvantaged. You don't have many gigafactories, you don't have many resources. Then you get on the back end of this, and right now there isn't a single company in the U.S. that can make cathode quality lithium-ion batteries. So they then process it here, send it back to China, then it comes back here again.
Yeah.
So where this industry's got to evolve is it needs to get to where we have the full cycle processing capability here. And we're somewhat unique as Ecobat because we're in the front end of that. And we do the logistics, the discharging, the disassembly, the shredding, the production of what's called black mass, which is sort of all of the metals in one. Then it goes off to others who handle the very back end of the process.
Right. But Tesla isn't saying, hey, Marcus, handle this for us, or are they?
Well, they're saying they want somebody to handle it for them. And this is sort of where the contention is in the industry. Who is that somebody, though? Well, that is kind of open. I think the starting assumption would be the black mass processors on the back end. But what's actually happened is there is an oversupply of black mass processing, and there's a shortage on the front end of disassembly, logistics, and shredding, which is why we're wanting to invest in that front side.
So give us an idea of where things go in terms of with energy costs so high. And we only have about 30 seconds left, so sorry that we're running out of time.
Based
There's
on
so
what
much I
you
want to
see
get.
in your pivot, we've only got 30 seconds. Well, you'll have to come back at another time.
Well,
but based on what you're seeing, this pivot, right,
Yeah.
to alternative energy EV, like what are you seeing, or how quickly? Real quick.
Well, I'm gonna leave you with something to think about. I'm kind of almost answering your question. As you think about the story in lead, it is the best recycled product, and it's also, if you don't get it right on the recycle side, you are not going to have the climate changing elements necessary to deal with wind power and solar power. You need energy storage.
Right.
And that's going to come about through companies like Ecobat.
Right, and we need it to be really efficient. A million more questions, so that means you must come back. Where are you based?
Santa Fe and Dallas.
It's an easy flight. Marcus Randolph, Executive Chairman, CEO, and President of Ecobat, joining us in studio. Man, a busy day. I've got another one tomorrow.
Yeah, let's do it. Let's do it tomorrow.
All right, you're listening and watching Bloomberg Business Week.